Hello, ladies and gentlemen. It is me again, Sal. Thank you so much for watching. And you guys know this is one of my best and most favorite shows I like to do with my good friend Jonathan Bogan, author, lecturer, educator, and again, writer of Say No to Big Government, available right now in Kindle and paperback on Amazon.com. The link is in the description. Again, the link is in the description. He also has a YouTube as well as Twitter profiles that you can follow him on. And please do so if you like the material that we discussed today. So please, John, again, thank you so much for being here. Go ahead and let the people know, outside of what I've said, a little bit more about yourself for those who don't know who you are.
Yes, well, as you mentioned, I do have a book called Say No to Big Government, My Case for Maximum Freedom, in which I go through the history of the United States as well as the world, but mainly the United States, in terms of how we got to be a country where our ability to prosper economically is more difficult than ever before, and it has everything to do with government. We began going down this road over a century ago. So the book really shows us how we have screwed up our economic system with too much government, and how we can get back to a country where we used to have robust growth and prosperity again, by reducing the size and scope of government, meaning lower taxes, fewer regulations, freer markets, strong money, individual liberty. And so I've been promoting my book and also using videos on YouTube, on my YouTube channel, Libertarian Black Man, to promote the same viewpoint, talking about events that take place in the news, as well as history and just libertarian philosophy. So I have an agenda to try to get people to vote differently, because at the end of the day, that is the most powerful weapon American citizens have to make their country better from a policy level. It's with their vote. And we have to influence voting behavior in the right way if we're ever going to hope to do something about the higher cost of living, the higher cost of healthcare, education, housing, the widening gap between the rich and poor, and so many other things that have displayed dysfunction in our economy. So that is my entire purpose for pushing forward this agenda, influencing better political participation, and more importantly, the forwarding of libertarian policies in government.
There it is, ladies and gentlemen. And again, he is here with us to discuss about, what is going on in the markets, how the political events that are going on are affecting our equity, bond, and security and derivatives market. And ladies and gentlemen, we're going to get started on that right now. John, we are now 1,700 points below our all-time high. It's been a drastic move to the downside in the market, as we recently found that the German 10-year Bund, which is basically a treasury note, for those of you guys who don't know what that is basically a debt security, a debt instrument with a fixed note that governments around the world sell to people. The man has been so strong that it's now gone negative, meaning that if you borrow money from the German government, they'll actually pay you less because they've got more than enough buyers to buy their debt. That's not a good thing. That's not a good thing because it shows that individuals don't believe in the capital markets, so they're moving to secure and safety net in these bonds. John, why are we seeing interest rates all across the world dropping? We just had the U.S. 10-year note down to 1.4%, now moved down 40 basis points just from a month ago. The 30-year Treasury note down to 2.2%, which is just a few basis points above its all-time low back in 2016. Everything seems to be going the wrong way. What's going on, John, here with why money is getting so cheap, and why are people running to these fixed assets to find a safety net?
Well, a lot of people are seeing that the entire world economy is slowing down. And people are trying to run away from the riskiest assets. So we're seeing stocks lose a lot of steam. We're seeing people rushing into, like you said, the safety of securities. And so we have central banks that control pretty much every single economy in the world, whether it's Europe, North America, Asia. It doesn't matter. The whole entire world is under the control of central banks, and they artificially manipulate interest rates and in the direction of downward because it's about stimulating the economies. So we have economies that are full of debt. I mean, they're overloaded with debt. We have countries now more than ever that have debt to GDP ratios of over 100%. And in the case of Japan, which is the most indebted country in the world in terms of debt to GDP, theirs is over 230%. So we have debt that is weighing down the economies of the world, and as a result, central banks are trying to stimulate by depressing interest rates and going negative. We have negative interest rates in Europe, and we've had them for 5 years, as well as Japan. And even countries outside of the European Union, such as Switzerland, they've had negative interest rates, but it doesn't grow the economy. All it does is grow the debt load, because a negative interest rate is entirely, it screws up the entire economic system, where you're supposed to be incentivized to save money and you get paid for it. That's what the interest is. If a negative interest rate is charged, then you actually lose money by saving it, and you end up making money by borrowing it. So with a negative interest rate, you're being paid to borrow and spend money. Effectively, you're being paid to go into debt. Now, on the other side, if you're someone who wants to save money, you're being penalized for saving money, because you're going to get paid no interest, and you're going to lose principal. Whereas if you're borrowing, then you don't have to pay any interest, and you don't even have to pay the full principal back. That's what happens with a negative interest rate. It's all a big scheme to try to stimulate the economy with debt. And as a result, you'll see these European countries, for the last 3 years, many of them have been growing at 0% for the last 3 years straight. For all the negative interest rates, all the quantitative easing, all of the debt and stimulus that central banks and governments have been pumping through their economy, that hasn't produced any growth. So why they continue doing this, the only explanation is that they're afraid of a recession, because a recession will collapse so much wealth, and they're afraid of what the social consequences could be if you see so much wealth evaporating in a recession. So that is the motivator, is to prevent a recession. But the price of that is to forego any meaningful economic growth.
Mm. Incredible. John, how do these countries get away with it, and what happens when basically what is there an end game for this? Is there a moment in time when this can't work anymore? In fact, you had mentioned that Japan is at 230. The International Institute of Finance recently posted a paper that said that China had actually topped 300% of GDP, $40 trillion. in debt. Nearly 15% of all global debt is in China alone. United States, by the way, now at 105.4% of debt to GDP. If this continues to grow and grow and grow, is there an end game? Because we've heard about a new theory, John. I'm sure you've heard about it, called MMT, or modern. I want to say it's called modern market theory or something like that. Where I might be getting it wrong. Where basically these countries believe they can continue to borrow and borrow and borrow, particularly the United States, and there really wouldn't be any downside effect to it in the long term. Do you have any data or example to counteract the idea that running deficits could, in the end, cause a severe and major depression, recession in the market, in the world? Period.
Yeah, well, yeah, MMT, that's a modern monetary theory. And really, it's just another way of saying how central banks do things today to stimulate economic growth, which is a big fraud. There's two directions that you can go when you have too much debt. Number one, you can default, which means admit that you cannot pay the debt that you have accrued, and say, hey, look, to all your creditors, that you're not going to get back 100%. You'll get back maybe 80%, 60%, 40%, or if you're really overloaded with debt, something less than 10% possibly, which is where we are, I believe. The world is in this position. We have $250 trillion of debt in the world. And the global GDP is only about $80 trillion, but that's not the real number in terms of how much money exists. The real number is about $30 to $40 trillion of physical cash that exists. So we can only pay maybe about 15% of all the debt in the world with all the money that physically exists in the world. So we would have to default almost completely to zero in order to get the economy back on track. Now, that's one direction, is a default. But there's a second direction, and it's a worse option, and that is to try to print money in order to pay the debt. That's where you get hyperinflation, because now you're going to create money out of nothing to pay people, but you're not actually producing enough goods to bust the inflation that you're creating. So I feel that is the direction we're going in worldwide and in America, where instead of doing an honest defaulting of our debt, which is a bankruptcy where you admit, hey, you don't have the money to pay, everyone takes a haircut, or takes more than a haircut. Instead, we're going to default dishonestly. We're going to print money and try to tell people, hey, we're paying you, but the money that we're paying you is going to be worth less. It won't buy as much because we're just creating it out of a printer and out of a computer. So, and really that's been going on already, and throughout a lot of countries where the economic growth rate has been stuck at 0% for years, because you're not growing the economy by printing money or by artificially low rates. All you're doing is growing the debt, and at some point the debt's going to be so big that we're going to have to go into a hyperinflation in order to pay the bills, or go into a default, which would mean a global depression. So those are our two options, a bad option and a worse option. Going into a depression would be a bad option. Going into hyperinflation would be a worse option. So we need to have a global depression if we're going to get our have any hope for the future of economic prosperity.
John, recent GDP report back on July 26th, consensus forecast was 1.8% for the second quarter of 2019. Came out as 2.1%, beating consensus forecast. That gave people the opinion that although GDP was slowing in comparison to prior quarter of 3.1%, almost, well, I think that's about 26% or so, 23%. It still showed that we were quote unquote healthy. Do you believe that 2.1% GDP number? I mean, how real is that growth? I mean, when Trump shows, all right, when our economy shows that we rose 3.1% for the quarter, how do they necessarily prove that? Because, I know it's not something where we can just kind of physically look around us, but how were we able to generate 2.1% of GDP growth? How exactly is GDP growth shown in the economy?
Well, it's all based on the production of goods and services. In other words, when people spend money, then that gets added to GDP. When there's a transaction, the value of that transaction adds to the GDP. So if I buy something from a store and the store has my money and they use that money to buy something from another store, that's a transaction. Every transaction, the value thereof gets added to GDP. So if you have a lot of transactions taking place, then you're going to have that will grow your GDP number. A lot of money changing hands will also add to your GDP number. So if the volume of money going from one person to another is large, that will increase GDP. Or you can have a smaller volume of money, but it changes hands multiple times, many more times. That will also add to your GDP. Now, the problem with that is much of it is being fueled by debt. Much of it is being fueled by the borrowing and spending of money. Every time our GDP grows, our debt ends up growing more. So it's really setting our country up for a depression. The GDP may go up, but the debt tends to stay ahead of the GDP because GDP is being fueled by it. People are not saving money as much as they used to, and so they really don't have disposable income. So when when people spend money, they're using their credit cards, they're taking out loans, and it adds to the GDP. It makes the economy look like it's growing, but it's not sustainable growth because the debt is just growing, and that is a bubble waiting to burst. So once it gets to be too large and can't be supported because now there's too much debt and not enough disposable income and interest rates have to go up, that's when everything comes down. So GDP can be deceptive. You can look at a number and it makes you look good until you look at the underlying reason why your number looks so good. It's because a lot of phony money in the background is lifting your GDP. And ultimately, the GDP has actually been slower over the last 10 years than ever in history. We don't grow our economy with real growth anymore. We're growing at 2% over the last 10 years, when in previous decades we grew at 3, 4, 5, 6, 7%, and it wasn't debt-based. It was actually real productivity that used to grow our economy in generations past. Now it's just debt, and we don't even get the growth to make ourselves proud of it. But it's unsustainable, and the debt is going to bring the economy down at some point, and I think sooner rather than later.
Ladies and gentlemen, again, we are watching on the screen. My guest John can't see it, but we're seeing gold slowly coming off the highs. Gold hit $1,500 today. And ladies and gentlemen, gold, I mean, what an incredible asset, if you want to call it that. I know some of you guys who watch the show have things to say about it, but at the end of the day, gold up 23% over the last year, 60% over the last 10 years has been an incredible investment for those who have held on to the product over time. Obvious concerns across equities has individuals moving to this safety net, John. But look, for the common person, we can't go out and run and buy bricks of gold, right? So, John, what happens to the individual American in an environment of negative rates? They obviously can't borrow at the rates the banks borrow. Uh, what happens to you as a normal everyday American? A new report here by the government said that household income rose to $61,000 this year. Again, that's not. Maybe I'm living in another country, because I just don't see that when I look around and I drive around America. I don't see people with to me doesn't look like that kind of household income. But maybe they're just, as you said, not able to save it, and instead just basically spending as soon as they get it. But in a negative rate environment, in an environment where GDP where debt is now crushing the economy, what happens to the normal everyday American? How do they live in a negative rate environment?
Well, it's going to be difficult. They're going to get punished for saving money, which will discourage them from saving money. You will see people wanting to put their money in either a safe, which is just a box where you put your money and you won't earn anything, but you won't lose anything. But then there's a risk if you keep that safe in a certain location that it could be lost to criminal break-ins or some situation like that. So what people have been doing actually over the past decade since the financial crisis ended is putting their money into riskier assets. Mm. It's one of the reasons why the stock market has been rallying for the last 10 years. And it doesn't make any logical sense from the standpoint of economic growth. A lot of these companies have been not earning very well. They have been gaining lots of debt. Many of them they're buying back their own stock to make the stock price appear higher so they can draw in new investors, which is just a scam, a total scam. They're basically going into debt to try to encourage people to invest in them by manipulating the stock price. But again, this is what people have been doing, because the interest rates went to zero starting in 2008, only lifting up from zero in 2017. Mm. So about 9 years of getting paid nothing on your bonds, on your securities, and it has pumped up the stock market. People who are now retiring, because the baby boomer generation, which was the largest generation that we've had, they started retiring 8 years ago. And many of them did not have anything saved up for retirement or didn't have enough. So to try to make up for lost money, they jumped into riskier assets, the stock market. Mm. The bonds are paying 1%, 2%. You can't really live on that. So people have been moving their money into riskier assets. And because their interest rates are so low, but they haven't been negative in America. They've been negative in other places. When interest rates go negative in America, that will turn everything upside down. And I believe that's going to happen soon, where we have negative interest rates. You'll see people buying safes. You'll see more people panicking and trying to put their money into very risky assets in order to hope to make enough income to survive. But exactly how it's going to look, nobody knows, because we've never been there before where we've had negative rates. So it is the worst idea, but it's a desperate idea, all to avoid a recession, when in fact a recession is what this country needs. It would be painful, but it would be temporary. And it's the only thing that's going to allow our economy to start back from a solid foundation and produce real growth, not this phony debt-based growth.
Yes, John, I know we've talked about it in the past, and I know we'll hit on it again tonight, that the recession of 2008 was a real missed opportunity for America. And what Barack Obama did was I think, in our lifetime, would be looked at as a major, not only a major violation of capitalism, but truly a travesty to the American people, what we did there in 2008, 2009. To really hit on what you just talked about on buybacks before we get into that, S&P companies this year bought $940 billion, John, $940 billion in stock buybacks. We just had Congressman Ocasio, the very well-known, for good and bad, out of New York. She tried to put together a plan to possibly ban stock buybacks. Again, that's incredible, John. $940 billion in 1 year alone. I mean, this is absolutely incredible that was even taking place, where these companies are literally borrowing money at low interest rates to buy back their own stock. That should be illegal. I mean, shouldn't it?
Well, it used to be illegal until the early 1980s, and the reason was because it was just a manipulation of the stock price, an attempt to make the stock look like it's attractive, because what investors like to see is stock prices going up. That signals to them, jump in, because you're going to make money. If you see a stock price rising, then that is often enough to entice investors to buy the stock so they can ride it up as high as it will go. Well, if companies can borrow money for nearly nothing percent and use it to buy their own stock, which pumps the price up, then it sends the stock price up, but not because you have legitimate investors who are saying, wow, that company is growing, they're earning money, they've got big profits, they just bought this company and their market share has increased. It's not growing for solid fundamental reasons. It's growing because the interest rate on the money the company borrowed was so low that they could borrow $100 billion of it and then spend it on buying back their own stock. There's no way this would be happening if interest rates were much higher. If they were at normal levels or at levels that they used to be at before the last decade, there's no way this much stock buybacks would be taking place. I mean, nearly $1 trillion in stock buybacks. That's possible only because the interest rate that banks were able to borrow at were at 0%, which allows for the money that when people borrow from the bank, that brings the rate down. If the bank pays less when it borrows, then people who borrow from the bank will pay less. So it distorts the economy. It causes it incentivizes a lot of behavior that would not have taken place before. So it's just the manipulation of interest rates has effectively manipulated all the prices whether it's stocks, whether it's real estate, whether it's household income. All the prices in the economy are manipulated, and it all starts with the central bank playing around with interest rates because they control the entire money supply.
Whew, John, wow, devastating news to hear. Uh, Man, this just sounds like we're just not going in the right direction at all as a country whatsoever. And I just don't see how we're going to avoid this as we've got possibly on tap for us, having a Democratic president. We have Donald Trump saying a lot of inflammatory things, getting himself in trouble, obviously. Things in the economy not looking so well. He could very well be facing a Democrat while in a recession. That, of course, would give any opponent a huge edge and the opportunity to win. And, John, when we look at all of the candidates who are running right now, they are all proposing policies that would require massive government spending. Uh, we already have a president who's spending a lot of money. We just had the conversation about the debt situation. Would a Democratic president be basically the icing on the cake for a possible recession? Or does this spell another Obama bailout situation? Could we even possibly do a bailout again? I mean, what do you see, John, happening if we get a Democratic president into the White House? Obviously, this person is not going to be someone who's going to be about keeping the federal deficit low. Give me your take on that.
Well, I mean, it would just make our situation so much worse. Every single Democratic presidential candidate, as you just stated, is proposing more federal spending. Keep in mind that we are already taking in trillion-dollar deficits now. And we're not even in a recession. The government has a revenue of over $3 trillion now, but it is spending over $4 trillion. And that's just to maintain things as they are, without all of these new programs that the Democrats are proposing. So, and that's without a recession. So if you get a Democratic presidential candidate and a Democratic Congress, which we don't quite have, we have a Democratic House of Representatives but not a Democratic Senate. That could change in the next election, where Democrats could win the Senate back and we get a Democratic president, plus the Democrats maintain control of the House. Now, if we have that, then big spending programs are coming on top of what we already have, and bigger deficits. And if we have a recession, and I should say when we have a recession, that will just make everything that much worse, because a recession will dry up tax revenue. So instead of the government taking in over $3 trillion, it may only take in $2 trillion, which would make our deficits go from being $1 trillion to $2 trillion. The wild card is the recession. When it happens, how long it will last, and how severe it will be. Bailouts, that's another wild card situation, because on the one hand, if we're in a recession, then there will be calls for more bailouts.
Absolutely.
And as we saw last year and this year, the trade war that President Trump has launched has hurt American farmers so much that last year he had to bail them out with $12 billion. This year he had to bail them out with another $16 billion, so that's nearly $30 billion in a year's time, because the trade war is only about a year and a half old. It's already cost farmers $28 billion. And now the president is talking about a tariff of 10% on the remaining $300 billion of Chinese goods. That means that all the goods coming from China, and this will start September 1st. He's announced that. September 1st, a tariff of 10% on the remaining $300 billion of Chinese goods. So by the fall, it is quite possible we could be seeing every single import from China, of which is the total of which is $600 to $700 billion, all taxed. And we're talking about now not just taxes on aluminum and steel, but taxes on the stuff that we buy directly when we go to the store. So the president so far has set his sights on that. And that could very well push us into a recession next year. The economy is already slowing down. Next year, we go into a recession. Like you said, the presidential candidates on the Democratic side could gain a lot of momentum, seizing on the recession, blaming Trump, and then saying it will be better when I get into office and we're going to have universal health care and free college and housing and jobs for everyone that pay living wages. It's a fantasy that everyone should be able to see through, but unfortunately, we're too caught up in the hype, and we believe as a country that can happen. We cannot even support the programs we have now, but we're going to go into expanding these programs 5, 6, 7, 10 times over. So, I mean, I say get ready for a lot of mayhem in America starting next year and the year after and so on, because there's so many things that are just scheduled to go wrong. A recession, possibly a Democratic president, and bailouts that could happen, but we don't know if the politics are going to allow for them. One way or another, we are going to go either into a depression or a hyperinflationary situation. So I am not optimistic at all about the next several years.
Oh, man. This is going to be a trying time for America. And God bless us all as we try to get through this, because there are a lot of people, John, that I don't think are going to be mentally strong to be able to make it through this. We've got a lot of people who've been living a very privileged life, in particular the nation's top 1%. Today, a French language program, France 24, released an interesting statistic, John, that said if the economy continues to go on the current path here in the United States, that the top 1% of America, 10% of America, would own 100% of America's wealth by 2052. You had just recently mentioned that a depression would be the greatest thing to ever happen to America, and for America's middle class, America's poor. What do you mean that a depression would be a good thing? How exactly?
Well, what I mean there is that it would be painful for a short period of time, but in the long term, you're actually flushing the economy out you're flushing a lot of bad things out of the economy that are preventing the middle class from growing. You have a lot of debt. You have a slow-growing job market. You have a lot of inflation in real estate, in education and housing. And, of course, the gap between the rich and the poor widens when you have this type of economy where the central bank and the government effectively just pump up the assets that the rich own with low interest rates and quantitative easing. A recession is going to wipe out a lot of those things. And it resets our economy to where companies stop wasting money, they stop borrowing too much money, they start becoming more efficient. When crunch time comes, it forces people to get smarter with their money. It forces businesses to get smarter with their money. And ultimately, if you have a smaller government and lower taxes and fewer regulations, then it makes it easier for a middle class to develop, because it makes it easier for economic growth that is based on real money, not fake money. It makes it easier for the economy to grow. Now, a recession could actually get a lot of businesses to push for deregulation, or push for lower taxes, push for government programs to be shoved out of the way so that they can actually grow again. But the problem is it could turn in the other direction, where more regulation is being called for. But tax cuts tend to be very popular in a recession because you're putting more money back into the hands of the people. This is what happened in 2001 when we had a recession. And tax cuts came in that year. And the economy was still sluggish for the next couple of years. So we had more tax cuts. Also in the early 1920s, a severe recession. And what happened? Tax cuts came in. We had robust economic growth after the tax cuts. 1940s. World War II ends. Government spending slows down and is cut dramatically. We do have a small recession, but we also have some tax cuts. So if you have a recession, it can actually start the ball rolling on trying to get taxes cut, trying to get regulations diminished. That will help grow the economy. But it also liquidates debt, because a recession forces people to go bankrupt who've gotten into too much debt and can't pay their bills, and ultimately those people and those businesses come under the ownership of others who actually manage their money better. So it's really just a reshuffling and a reorganization of the economy, trying to get it to a place where it can start to grow without debt, but grow with real efficiencies and savings that are created when people are spending their money more wisely. Over the long term, the economy would come back and you would have a more robust middle class. But we're not going to have that until we go through the painful recession first.
Absolutely. Because, John, we've got millions of Americans right now who are millionaires, billionaires, hundreds of billionaires on paper, literally on paper, because of the price of the stocks that they own. And due to that, they're able to borrow against that, and our fractional reserve banking environment, then takes that and exit by 10. And I mean, it just seems, John, that this is just an entire loop of destruction just waiting to fall apart.
It absolutely, and that's the sad thing about it is I think we're just going to keep doing it until we encounter the kind of crisis that really hits a lot of people who had nothing to do with it. It's such a sad thing when you think about, for example, so many people who are retiring, who have pensions on the line. People are now retiring at the rate of $11,000 per day.
Wow.
And it's been that way for 8 years. Starting in 2011, the first baby boomers started retiring at the rate of $11,000, not per month or per week, but per day.
Jeez.
Because there's 76 million of them, at least, roughly 76 million of them. And you probably know some people who 10 years ago were not retired who are retired now, or maybe even 5 years ago who were not retired who are retired now. They have pensions now in the market, in the stock market. They've got 401ks. They've got bonds. They've got money in accounts that are dependent on the stock market going up. And when everything comes down, or they may be retired from a company that is paying a pension but is also deep in debt and could go bankrupt in the next recession, which would mean the end of the pension. So this is the really sad part, is that so many people who are just, they're not in a position necessarily to go right back to work for 40 hours a week in the same job they had all their life and have their nest egg. A lot of that is going to get wiped out in the next recession. We have never had in the history of our country or in the world so many people dependent on an income that has never been so vulnerable to a recession. So this is really the legacy of producing all this debt, having central banks and governments depress rates, manipulate the markets, and now we're realizing that we're hitting a wall and we can't do this anymore in a way that makes us feel good. Now there's a consequence that's going to have to be paid. And unfortunately, those who are most vulnerable, I believe, are going to be very much in the line of fire of that.
That's incredible, John. And we're going to move from a country where basically, we had this huge generation contributing to America's coffers to now extracting that wealth out of America's economy. And I truly do blame the baby boomers for basically for where we are right now in the economy. They will no doubt go down as probably the greediest generation to ever live in America, because these people, the way they, basically gambled it all, and they will definitely go down as, I think personally, the worst generation this country has ever had. John, what kind of effects will it have? Because I want to get down to a little bit the local level here, local and state government infrastructure in terms of the state apparatus, city apparatus, where you have in some of these very cushy cities, like a Detroit, like a Southfield, like a Livonia, like a Los Angeles or New York or Dallas or Houston, where you have people who've just been very comfortable, right, for 25, 30 years in these little government positions where they don't really do much, and they've got holiday pay, and they've got all of these really cushy jobs. What happens to those people, to those positions, and to the large structure when we can get into the police infrastructure where you have cities like New York and LA where 25, 30,000 people involved in just the police alone? What happens when these cities aren't able to generate the kind of tax revenue they need to sustain those operations? These are cities that have really built themselves up based on, again, the wealth that was coming in through baby boomers, through increased paper valuations of real estate and corporations and businesses. What happens to that infrastructure, John?
Well, it's going to be another one of those situations where they come to the government for a bailout. It is almost second nature now for so many different local governments, state governments, corporations to go to the federal government, which is the only government that has the legal right to print money, and say, look, we're going to need a bailout because the local governments can't print money. That's why a local and a state government can actually go bankrupt, as we saw 6 years ago with the city of Detroit, the largest municipal bankruptcy in American history, because Detroit cannot print money. So they have to actually tell their creditors, we can't pay you. And that will then, that's a loss to the creditors, but of course it hurts the ability of the city to borrow in the future. So they have to actually reduce services, which is what they should have done. But that's what cities around the country are going to have to do. That's what states are going to have to do that are heavily indebted. The most indebted state in the country when it comes to pensions is Illinois, with over $100 billion
Jeez.
of unfunded pensions. And actually, it might be, that was a statistic from a few years ago. It could be up to $200 billion of unfunded pensions. And they are first in line to seek a bailout of some kind because, again, they cannot print money. So you have to go to someone else to get bailed out, or you're going to have to default, which would mean a lot of pensions getting cut, maybe even eliminated entirely. So you're going to see, and actually one of the things you'll see is a lot of cities that can't pay the bills outsourcing a lot of the services that they were providing to private companies, so such as trash collection, or maybe even fire department services or road construction. Now, I think that is exactly what we need. We need cities to become less dependent on the taxpayer, less dependent on trying to serve directly the citizens, and start outsourcing to private companies a lot of the services that it just can't afford to pay for. So they have to sell a lot of, and that's why you've seen a lot of schools closing in a lot of certain inner cities like Detroit and many others. They don't have the tax base to support the schools. They don't have the students in other words, they don't have the students that provide income through enrollment. So you have people, they have to sell off anything that is costing money, that is not returning money. So that's what and that's what we need to see throughout the entire country. So I think actually there's a good side to this recession hitting local communities. It's going to force them to cut their costs. And that's what businesses are doing. I heard today Walgreens is closing hundreds of stores throughout the country because they're trying to cut their costs. And Lowe's, another store, closing many stores and laying off thousands of workers to cut costs. Of course, General Motors announced a couple of years, or last year, that they're going to end up eliminating over 14,000 jobs. And Ford also doing that throughout Europe. It's all about cutting costs. There's too much debt that cannot be paid, and you're going to have to see people lose their jobs, lose their income. Is a sad thing in the temporary situation, but it's necessary in order for things to get back. And the infrastructure of our country will come back. All of these things will come back if we make the right decisions now versus postponing them another 5 years.
John, we're seeing I got a ticker pulled up here, MUB. It's a derivative based on the cost of municipal bonds sold all across America. And what I'm showing is that this is going up. The price of this derivative is going up, showing that many people across the world, across America, are, driving into these municipal bonds. And these are basically, for those of you guys who don't know, another debt instrument used by local governments to finance public projects, roads, schools, airports, seaports, and other infrastructure-related repairs. John, I from what I know, and I'm sure you can shine a little more light on this, those are not necessarily guaranteed returns. Is that correct? When somebody buys a municipal bond, that's not necessarily guaranteed to be paid. Is that right? Or
well, I mean, you can say that about pretty much any bond. because remember, a lot of people lost money on Detroit municipal bonds when the city went bankrupt. So it's hard to trust anything out there. There's a lot of municipal bonds, and they offer higher interest rates because, unfortunately, the debt is junk rated because the city is not bringing in enough money to pay debts. Debts keep growing. The credit rating ends up falling, and you have a situation where default is very likely. I mean, you could get paid only until there is a total admission that the debt cannot be paid and you have a bankruptcy, like we had in Detroit. So bonds are, unfortunately, a lot of them are very risky, which is why the interest rate is higher on certain bonds. But I once again, people have rushed into junk bonds over the past several years because safer bonds are paying 0 or 1 or 2% when they should have been paying 5 or 6 or 7%. Puerto Rico is loaded with debt. And I heard a report a few years ago that 20% of mutual funds were invested in Puerto Rico, where the bonds are junk status because they don't have anywhere near the money to pay the debt that they have, and they need to borrow to try to keep themselves from having to default and have a recession. But as a result, people have invested in risky bonds, and with the day when they default, it's going to force a lot of the bondholders to take a cut. So, no, you really can't guarantee anything. This whole entire world market is so manipulated, it is so skewed that it's hard to say anything can be guaranteed anymore except dysfunction. I can say that dysfunction is guaranteed because we already have it, and I see it escalating as the debt continues to grow and become less sustainable. Dysfunction will escalate, and it will be hard to trust anything, whether it's a stock or a bond. So that's why the best thing you can do is diversify. And diversify doesn't just mean different stocks or bonds. It also means holding physical cash. It also means holding precious metals. It also means not just investing in financial assets, but in tangible things that one may need personally in an emergency. Because the financial system has never been less trustworthy than today.
Oh, John, that's a whole nother conversation, getting into those things when we're talking about non-financial things we're all going to need during a recession, depression. I can only imagine what the cost of a flashlight would be in times like that. Obviously, we would hope that our nation's energy infrastructure will be able to maintain itself during a recession, depression. How they would get paid, how they would run, I don't know, but we'd hope that people much smarter than us would come up with the solutions to keep those things running. I would say it's a good time for people to learn a little bit more about how life was during the Depression. What was day-to-day life was. I know there are not many people who are still surviving from that time. Maybe their interviews or books or something we can go back to learn about how day-to-day life was during the Depression. I think that would be a very good, at least, foundation of education someone could be able to use to prepare themselves for that coming situation. John, when you look at the foreign countries, and I want to touch on those a little bit, developing nations, John, we have now a a country where the majority of our workers are older workers retiring, becoming burdens on the state, for lack of a better phrase. But when you look at some of these developing nations, particularly in Africa, Southeast Asia, but really in Africa, you're seeing populations where they are, for example, a country like Nigeria, where you have nearly 60% of the population under the age of 18. Wouldn't recessions for countries like that be even shorter? Would they even feel a quote unquote recession? Obviously, whether it be South America or anywhere outside of America, most of their debt is, dollar based. How would life be with a recession in America and when you're living somewhere else where you're so dollar dependent, like a developing nation where, most of your imports are bought with dollars, most of your exports are sold with your local currency, which is falling against the dollar all the time practically. How does life, feel for those people?
Well, in a recession, if we were to allow our economy to collapse as we should do, our dollar would get stronger because we are allowing the money supply to shrink. We're allowing this is without bailouts. If we just have a straight recession without bailouts, without stimulus, if we were to raise interest rates, if we were to do the right economic things, then you're going to have a stronger dollar, which will buy more. If you're in a country where the dollar is getting stronger against the local currency, then the more dollars you have, the richer you're going to become. So having a strong dollar is going to help everyone. It's going to help anyone who holds dollars, whether you're an American or whether you're in a foreign country. If you own dollars and the U.S. economy is collapsing and the money supply is shrinking, then that is one of the good things about a recession, is that money gets stronger. So it purchases more. It's the reason why during the Great Depression we actually saw more millionaires coming out of that than any other economic collapse in history. Not that they were making millions of dollars during the recession, but afterwards, because they were able to buy things for so cheap. They were able, because the dollar got stronger. You had one of America's richest people, John Paul Getty, whom I talked about in my book, became one of the wealthiest Americans during the 1950s and 60s because of the Great Depression. The dollar got strong until, of course, the New Deal comes in and weakens the dollar. But during the first few years of the Depression, a lot of the smart people decided to jump into a lot of markets for basically pennies on a dollar. And they were able to start businesses, and of course, regulation came in with the New Deal. But they got in quick. And once everything was over and the dust settled, they had a business. Once the New Deal ended, they could grow. They've already got their business set up because it didn't cost them much because the dollar was strong. And they were able to come out with a business that would only grow by millions and billions of dollars. So wherever you are in the world, it is a good investment to be in the U.S. dollar only, and I say only because this is a big condition, only if we were to allow our economy to collapse the way we should, without bailouts, without artificial stimulus. Unfortunately, I feel that the momentum will be in the direction of doing stimulus, sending interest rates back to zero and below zero. I mean, we've already started the round of bailouts with the farmers, $12 billion in 2018, another $16 billion in 2019, and probably, who knows, $20 billion maybe in 2020 or more. So if we get the right thing, then people are going to do well no matter what happens over the long term. But unfortunately, people don't understand basic economics. They think the best thing to do is to prevent a recession from happening instead of allowing it to reset the economy, make the dollar strong, and set the stage for the next round of economic growth. Instead, we're going to try to prevent the recession with below zero interest rates. Look at Europe. Most of those countries in Europe have been growing at 0%. With all the negative interest rates, it has produced no growth. We have not sent our rates as low as them, and our economy has actually looks pretty good compared to Europe's. But compared to how it looked 20, 40, 60, 100 years ago, this is the worst economy we've ever seen because we're growing at 2% when we used to grow at 4, 6, 7% a year. So I don't have a lot of optimism about what's going to happen as far as government policy. If we did the right thing, we would be all right. But the people are not informed about economics and about history and government policy. All they want is to be saved from a recession, not knowing that a recession would be good for them over the long term.
John, I don't even think the majority of people even know a recession is coming or even what a recession is. When you just going out and about, John, I mean, it just seems like so many Americans are really just oblivious to their political system. All they know is Republican and Democrat. They can't, most of them, name outside of the president, maybe the vice president, anyone else below them. Many people don't even know who their county representative or let alone state representative is for their district. I just really, like you, have the same kind of just sentiment of this isn't going to end up very, very, very good for us here. Let's try to let's end it on basically trying to figure out where we're going to go in the short term. When it comes to China deal, we're very, very day to day right now. I've never seen in my short time trading where so many people live on the edge of their seat for a tweet. I mean, this is incredible that we've got billion-dollar organizations running their companies on what the next tweet is going to say. I mean, this is just outside of all kind of just real traditional financing, traditional finance in general. We had Goldman Sachs come out today, and I posted that on my Twitter, God Penny Stocks. Follow me there. A link will be in the description. That they were looking and hopefully trying to see if we can get 2 more interest rate cuts before October, each at 25 basis points for a total of 75 basis points in cuts by the end of October. John, what would that do, at least on the short term, to our economy? We have a president who hates the high value of the dollar. He sees that as a negative. Why? I don't really understand. I think people are still trying to figure that out. But what does 3 interest rate cuts, do to the dollar and do to our markets?
Well, it's I think actually a lot of investors might start to become more pessimistic about the stock market, because just as we were talking about not too long ago, when the interest rate was cut 25 basis points, it caused the market to actually go down a little bit because the Fed was signaling that the economy was slowing down. And a lot of investors are getting ready for the next recession. if they see the interest rate falling, they're thinking it's time to jump out of the stock market because, in fact, the recession is upon us.
Mm-hmm.
So I think the interest rate would certainly have to fall more than 75 basis points in order for it to really start to stimulate the economy, because that would put us at, if it were to go down that much, that would put us at maybe 1.75%.
Oh wow, John, that'd be low. I mean, that's incredibly cheap for money.
Yeah, and the thing is, I think it would actually go lower, because remember in the last recession, the Fed did almost everything. They went to zero. They launched quantitative easing, 3 rounds of it.
Mm-hmm. And they're talking quantitative easing again, by the way. I heard conversations on that today on the business news, talking about QE at this point. It just boggles my mind here. We're at the highest, just off the all-time highs, and we're talking about QE here. Crazy.
Yeah, and it's going to be worse. It's because the next recession is taking place with far more debt than the last one, which would mean far more QE and lower interest rates in order to prevent the recession from lasting as long as it would, or from being as deep and as severe as it's going to be. That's why I believe we're going to go below zero. It's the only thing left the Fed has. We've already been to zero. Mm-hmm. We've already had trillions of dollars in QE. Doing the same thing next time around will be ineffective just because the recession will be bigger, because there's more debt that has to go down. There's more people with more money on the line now than last time. And so that's why there's going to be a level of dysfunction that we haven't seen, where we may go below zero. We've never seen negative interest rates as far as on a global scale until this decade, starting in Japan and Europe 5 years ago. The U.S., being the strongest economy of those two regions, has been able to stay away from negative rates. But this time around, I don't believe we're going to be able to, because everything has gotten worse in terms of debt, in terms of how slow our economy has grown. It's the 1-2 punch: a slow economy and growing debt, and then a recession is the knockout punch. So it's going to be acts of desperation by the government, by the Fed, to try to get rid of all that, get rid of all of the recessionary situations, the high unemployment rate, the loss of stock market values and real estate values. And exactly how it's going to play out, I'm actually very anxious to see, because we need a recession to take place. But exactly how, if it's going to happen, all we can do is hope that we're all prepared for it, because at the end of the day, everyone's got to look out for themselves. Looking for the government to do the right thing until we actually get the right types of representatives in office, which I am trying to encourage people to do by telling them to stop voting for Republicans and Democrats who do not believe in the philosophy of free market economics. Until we get the right people in office, we really will not have any hope of trying to prosper. So we have to look out for ourselves. We have to prepare individually for the next recession, not just with our money, investing in this type of financial instrument or that one, but personally, because we may have to move. We may be in a community in which a lot of disorder breaks out. It could happen. And when people are looking for food, when prices are high, when the stores are cleaned out, when gas stations are charging a lot of money, and people are just trying to make it, I think we're all going to be shocked at how crazy things can get.
Oh, wow. We will leave it at that. John, interesting conversation today. We're really going into really tough times here. We've seen incredible amount of volatility enter our markets. People are rattled. We don't know if this is just a situation like it was back in late October, November last year, and then a little bit earlier this year. You mentioned that volatility or disorder is the new normal. It really seems to be, a day-to-day type of thing where we're living where there's no structure. There's really no structure to the financial markets here because you really don't know what could be around the corner, what country, what bank is going to fold internationally. We've had banks already in China ask for their nation's financial head office to save them. We've had bank failures in Hong Kong. I mean, it's slowly working its way into Europe. It has, of course, not yet hit American shores, but we don't know what could be brimming under the surface as people are drowning under personal debt at the cost of billions and billions of dollars. With that being said, ladies and gentlemen, again, my host is Jonathan Bogan. All of his contact information is in the description. Please follow him on YouTube, follow him on Twitter, buy his book. The link is in the description. Again, available on Kindle and paperback. Buy his book. Leave a good review for him. John, I know you just already had some parting words, but is there anything else that you probably want to say before we end things out tonight?
Well, yes, I appreciate this opportunity and many other opportunities to come to share my views with your audience. We are definitely living in some very interesting and very uncertain times, and people need to be prepared because we've been living a fantasy for the past decade. In the wake of the financial crisis, people have been lulled into this idea that everything's been fixed, that the American economy is strong, that our best days are ahead of us, and none of that is true, unfortunately, because we have terrible representation in government that we have allowed and that we have supported as a nation. I most of all want to inspire people to change their representatives with their vote, because at the end of the day, we are going to continue down this road, and it's going to be a bumpy road, to say the least. That's a big understatement. Economically, we are, I think, done with this calm before the storm period, and things are going to ratchet up, and we are going to we're going to, I think, possibly see the end of this country as we know it, because there's just nowhere to go with the current representation that we have other than in a bad direction. And we have an election coming up next year. This is another opportunity for us to do the right thing. We have to bring down taxes. We have to reduce government regulation. We have to have a strong dollar, which means reduced government spending. We need individual liberties that we used to have to be brought back. That's the only way you're going to get a robust economy. It's the reason why our economy grew so well during the 19th and early 20th century. It's because we did not have big government. Now we do, and look at where it's gotten us. So, to all your audience, I would say go out and get a copy of Say No to Big Government, My Case for Maximum Freedom. Follow me on Twitter at Libertarian Black Man. subscribe to my YouTube channel, which is also Libertarian Black Man. That's the title, and I will make videos on a weekly basis talking about current events, talking about history, talking about economic theory, and really my opinions on what's happening in the world and what we should do about it.
Thank you again, John, for coming on to the show, ladies and gentlemen. If you've enjoyed what you've heard today, again, support John by purchasing his book and following him on his YouTube as well as Twitter platforms. My name is Lasali Nungu. Please click subscribe if this is your first time watching me as well. Until next time, everyone, take care.